trying to put more stuff, more treasuries, more money, more fiat currency into those pipes. When that pipe blows, that's when the whole system goes, not just in the USA, but throughout the planet. And that's why I think central bankers are buying gold hand over fist, and they're going to continue to do that. Thursday, January 2nd, 2025, Maneco 64, home of alternative economics and contrarian views. We're going to look at Wall Street and why Wall Street is worried about a tsunami of debt, and specifically a $50 trillion tsunami, and it could be arriving at these financial shores very soon. That's what we're going to look at today. Before I do, though, I like to give a quick shout out to my precious metals dealer affiliates in North America and in the UK. Here in the UK, if you're looking to add on to your stack, if you're looking to buy gold and silver for the first time, I always tell people to shop around and get the best deal. Or you could contact Gold Investments. I vouch for them. They've been in business since 1981. It's a family-run business, and you can contact them on the phone and talk to them and ask for advice, or you can just go directly into their website and buy gold and silver. And I have a few promo codes in the description for that, and also all the contact details for them. In the US, I'm affiliated with Miles Franklin. All their details are also below in the description. They're one of the few registered dealers for the US Mint. So, talking about gold and silver, let's go back to the debt, because that of course is the flip side of gold and silver, because gold and silver are money, and the debt is just that. It's the fiat currency, it's the debt. It used to be, of course, a promise to pay gold and silver, but of course that has been ripped asunder, that relationship, and that's why our monetary financial system is always so prone to major crises like we've had ever since the Federal Reserve was created, if we want to go back that far. I'm only going to go back as far as the '08 crisis, the 2019 Repo crisis, the 2020 crisis, and I think there could be a crisis coming. I'm not saying 2025, but soon. And it's not me that is worried about it. It's actually the mainstream financial sector, Wall Street. And I saw this article here on Bloomberg.com, and it came out on the 30th of December. And I thought it was very interesting. And you've got an illustration here that looks pretty appropriate. You've got Uncle Sam stuffing the system, the financial system, with more and more debt, and it's not fitting in, right? So before we look at this article, and I've read it, I'm going to put a link to it in the description. There is a paywall. I'm not sure if you subscribe to Bloomberg.com. But I wanted to read here from this book. It's called The Handbook of Fixed Income Securities by Frank Fabozzi and Tessa Fabozzi. It's considered like a must-have, a kind of Bible for the bond market on Wall Street and anywhere else. And this one I bought in 1995. When I was still working in the financial sector, and I worked in the bond market. And I've just marked here on chapter 7, talk about treasury and agency securities or government securities. And this is what they say about treasury securities or treasury bonds. Two factors account for the prominent role of U.S. Treasury securities: volume in terms of dollars outstanding and liquidity. The Department of the Treasury is the largest single issuer of debt in the world. Well, that basically means they're the biggest borrower, and they still are to this day, 30 years later. The Department of the Treasury is the largest, with Treasury securities accounting for more than $1.9 trillion, represented by over 180 different Treasury note and bond issues and 30 Treasury bill issues. So notice how it says 1.9 trillion in outstanding debt held by the public that's traded in the market. 1.9 trillion. Keep that number in mind. So why is the Treasury market the most important market for the current not just U.S. financial system but the world's financial system? Well, because the dollar is still the major reserve currency, and sovereign countries still keep large reserves of treasury securities, and that backs their own financial monetary system in each country. Yes, of course, we are seeing massive de-dollarization and a massive amount of gold acquisition by the major central banks in the BRICS bloc and others as well that are not, can we say, allied to NATO or the US. But it's still very important. But one of the reasons why I think countries are moving away from the dollar is not just to fight sanctions and political pressure from the US. It's that they can see the writing on the wall, and I think this article portrays that. So it says here, Treasury's elite bond dealers will struggle to handle 50 trillion debt. As US debt balloons, firms that play a vital role in ensuring the biggest bond market works properly warn of the risk of growing pressures. So this is by Michael McKenzie, Liz Capo McCormick, and Alex Harris. Let's go through this article. I'm not going to go through the whole thing, but I'm going to try to keep it to the sectors that I think are most important. But if we read the beginning here, you have an idea of what's going on. It was once the club every Wall Street institution wanted to join, the elite network of primary dealers who serve as gatekeepers of the world's biggest and most influential bond market, U.S. Treasuries, right? 30 years later, hasn't changed. Not so much anymore, just as America's debt load is poised to balloon beyond already record levels. A variety of forces has made membership in this vital cohort less coveted. In one telling example, Ken Griffin's Citadel Securities in September indicated it had shelved, for now, its long-touted plans to join the group, with the rise of electronic trading allowing it to earn a spot as a market-making giant, despite not being among the Federal Reserve's select counterparties. I've spoken about the primary dealers before. This is what we're going to look into here at the moment. It says, formed in 1960 by the New York Fed to ensure the smooth functioning of a treasury market that has since grown to nearly 29 trillion, and it is a benchmark for setting borrowing costs across the world. The current system of primary dealers stands at 24, about half the number at its peak in 1988, when U.S. debt was a fraction of what it is now, and before a wave of bank mergers So I told you to keep the $1.9 trillion number in mind. Well, we're now at 29 trillion. I mean, that's a huge multiplication of the outstanding debt. And according to this article, it says here, issuance has gone up almost threefold in the last 10 years. And the anticipation is for it to close to double to 50 trillion outstanding in the next 10 years. And that's debt held by the public. That's not the full national debt. The full national debt right now is at just above 36 trillion. So the marketable treasuries are at 29, but they expect this 29 number to almost double to 50 trillion in the next 10 years. Whereas dealer balance sheets haven't grown at that magnitude, said Casey Spizzano, head of U.S. customer sales and trading at primary market dealers NatWest Markets and chair of the Treasury Market Practices Group, the government debt watchdog sponsored by the New York Fed. This is what she says, or he says. You're trying to put more treasuries through the same pipes, but those pipes aren't getting any bigger. So yeah, that illustration in the beginning, there you go. Trying to put more stuff, more treasuries, more money, more fiat currency into those pipes. When that pipe blows, that's when the whole system goes, not just in the USA, but throughout the planet. And that's why I think central bankers are buying gold hand over fist, and they're going to continue to do that. So I've highlighted this comment by a senior portfolio manager at Vanguard, which is a huge financial institution. He says, I worry about the treasury market. We're now relying on principal trading firms to do a lot of the intermediation, but they're more short term. And in bouts of market stress, they step back as they are not obliged to make prices in those periods. So he's talking about firms like Citadel here and others that they're not primary dealers, but they are market makers, and they're not obliged to always be there making a market at auctions and things like that. And therein lies the problem. The problem really is a glut of debt. And also regulation, after the '08 crisis, banking regulations is made it hard for these financial institutions to participate fully in these auctions. And there's also been a lot of consolidation or mergers, so there's not as many primary dealers. And this is what this professor from Stanford is saying here. He says there is no silver bullet. According to Darryl Duffy, a professor of finance at Stanford University, who spoke at a Treasury market conference held at the New York Fed in September. And I quote, no single reform in progress or anticipated is going to solve this problem. So the other thing that they don't point out in this article that could make the problem even worse, that could make that $50 trillion amount come in even sooner than in a decade, is rising bond yields. So what it boils down to is that we could have crises like we had the repo crisis in 2019, and I covered that. I even have a playlist, if you want to look into it, a repo crisis playlist. That has been rearing its head at the end of, let's say, quarters. What is the repo market? Well, it's a market where a lot of these primary dealers, they borrow funds overnight. And when the system gets a little bit illiquid and people worry about liquidity, the repo rate can go above the Fed funds rate. And that, of course, caused a massive crisis that really culminated in 2020 That started in September 2019, and the Fed had to basically intervene and do what they called not QE at the time. But then you had, again, this system, treasury system, the piping blew up in 2020, and there was a massive spike in yields, and the Fed had to step in. And that's when they came in with massive QE in 2020. We are told that it was because of a health crisis, but I would say it was more to do with this. The health crisis was kind of a cover, I would say. I'm not saying nothing happened during that health crisis and that they didn't shut the economy, but it was a good excuse, of course, to have the Fed print trillions upon trillions. I think they were just below 3.5 trillion, and they ended up at 9 trillion, their balance sheet. So they like $6 trillion in less than 2 years. Yes, the regulatory environment doesn't help. They're talking about SLR. I covered this back in the day in 2020. So what is SLR? It says here specifically, bankers have cited burdens around the so-called supplementary leverage ratio, SLR, which tells them how much capital to set aside relative to their assets. While the Fed allowed banks to exempt U.S. government debt from these calculations when Treasury market liquidity evaporated in March 2020, so they could have more bandwidth to step in, they let that exemption lapse after a year. So they can't, unless they bring in the SLR or exempt the banks from the SLR again, there's going to be trouble. And if they do exempt them, the people are going to smell trouble. So it's very interesting situation, actually. So what do you do in this environment? Well, I'm not saying you should run away from the financial system or run away from treasuries, from investing in treasuries, even though I don't, because I don't trust it and I don't want to finance governments, not the US government, not the UK government, not any government, because I think they're not responsible. They don't really do things honestly either. So I stick to my own central bank. And what is that? Well, it's holding a few gold coins, maybe a few bars, and quite a bit of silver. I think silver is a great way to get out of the system for those of us who are not multimillionaires or billionaires. It's the money of the public. Anyway, primary dealers as of December 2024, so you can see here, there's a list of the primary dealers, and it's interesting that one of them is Cantor Fitzgerald, whose CEO or chairman, Howard Lutnick, almost became, there was a kind of a battle between him and Besant to become Secretary of the Treasury, but he became the Commerce Secretary. But nevertheless, you can see that his firm is a primary dealer. And it's interesting because there's also foreign firms like Bank of Montreal, Bank of Nova Scotia, Barclays, Daiwa from Japan, Deutsche Bank, HSBC, Mizuho from Japan, NatWest from the UK, Nomura from Japan, RBC Capital, that's UK, Canada, RBC, Santander, that's from Spain, Societe Generale, that's from France. There's no Chinese primary dealers. So, yeah, we're going to keep an eye not just on treasury yields, but on what's going on under the hood or the bonnet, as they call it here in the UK. You're not going to hear about this, let's say, in the mainstream financial press on CNN, on Fox Business, or even on Bloomberg, you might. But most people focus on stocks and cryptocurrencies. But I think, as I said, the treasury market is the base for the whole world's financial system. If you think of Exter's inverted pyramid, it's just above gold and silver. And that's why it's so important to have gold and silver. So, yes, the markets have reopened after the 1st of January. So where are we right now? Well, it's 20 to 9 a.m. London time. We've got spot gold at 26.36. It's up about $12. High's been 37 and the low has been 26.21. Silver is up 35 cents or 1.2%. So pretty good start for now for silver. The high's been 29.42. Right now we're at 29.24 and the low has been 28.82. The Dow futures is up 160. The NASDAQ 100 futures are up 137 points and the S&P 500 futures up 26. So yeah, a little bit of beginning of the year buying, I guess, if you could call it that. What about the currencies? Well, sterling is down slightly. The euro is unchanged. The dollar is actually down 1/3% versus the yen. The Swiss franc is unchanged. So the dollar is at 90.52. What about crude oil? Well, WTI crude is unchanged at 71.60. Brent is at 74.70. High-grade copper is down slightly at 403. And let's finish off with the treasury yields. The 10-year yield is down about 2.5 basis points at 4.55. And here in the UK, let's see where the gilt market is trading. Yeah, things are not great. The 10-year gilt yield is up another 6 basis points at 4.63. And the 30-year yield is up 10 basis points at 5.20. So with that, I'm going to wish you all a very good day. Take care. Bye.